The purpose of this video is to address the question of compensation for corporate business owners. Should they take dividends or salary? And my position is that you need to look at the long-term implications before you can make that decision. Now, in our example here, we have Pat, and Pat is earning about $200,000 a year. And if we break that down, we can see she's spending about $125,000 for her lifestyle. This is the amount going to CPP, and this is what she's paying in income tax. So the question is, can we reduce this by taking dividends? So let's go and look at our corporation for a second, and we can see, again, the corporation is paying out $200,000 a year, and the corporation also has to make CPP contributions. But what happens if we pay dividends? And I'm going to set this up here so that we're paying ordinary or eligible dividends. And we can see there's about $177,000 paid out. And if we just want to go and confirm and look at her salary, we can see there's no salary and no CPP payments are being paid. Let's do a quick comparison here just to check to make sure the company's paying out equal amounts. And we can see here on this side that we're paying dividends to Pat, and this side we're not paying the dividends. This is salary. But we can see the money going out of the corporation, 202, 202, it's about the same. Okay, it's close enough for this comparison. So let's go back and let's look at the personal planning side. And what we need to do is we're just going to bring in the information from the corporation. And this is how we integrate the personal planning and the corporate planning. And we can see here now Pat's getting about $177,000 a year of income from the corporation. So let's do a quick comparison between the salary and the dividends. So here we see with dividend compensation on this side, salary on this side, income of 177, 200,000 over here. Let's break this down so we can take a look at it. And what we see, lifestyle spending. So Pat actually has more money to spend on this side when she got dividends than when she's getting salary. And we can see the difference here is in income taxes. And if we come here and we take a look over time at our lifestyles expenses, we can see that Pat's ahead by about $14,000, $15,000 a year by taking dividends. So right away this looks best, but of course remember when you take dividends, you're not contributing to CPP, so you won't have that pension, and you're not able to collect or earn RRSP contribution room. So let's take a look and see what happens if Pat does take full salary, but she makes RRSP contributions. And so what we've done is we've set up so Pat is maximizing her RRSPs when she's taking salary. But just to do a comparison, I'm going to suggest that she contributes the same amount to a non-registered account when she's collecting dividends. So let's go ahead now and do a comparison between. So now on this side, what we see, this is Pat taking a salary and doing the RRSP contributions. And this is what the money's accumulated to, and she's withdrawing in retirement, and then she runs out of money here. On this side, Pat's taking the dividends, contributed to a non-registered account, the same amount that she contributed to RRSPs, has the same lifestyle expenses over here on this side, but she's run out of money sooner. So let's break these down and take a closer look. Okay, so here we see $200,000 of salary, $177,000 through dividends. We can see in retirement, $2,033. This is the income that Pat's receiving. She's getting money from CPP, Old Age Security, and RRSPs. Over here, where it was just dividends, we were getting money from Old Age Security, and we're getting money from the non-registered account. So this is the difference in the two. So she's getting more money here. And when we take a look and see how she's spending money, we can see she's spending the same amount of money, $32,000. This is the taxable amount, so there is more tax owing when she receives salary. But again, if we go back and we look at how long the money is going to last, we can see it does last longer if we take the salary and make the RRSP contributions. So in this particular example, it actually works. It's better off to just take salary and make RRSP contributions. However, every situation is different. And really, you need to map out everything before we know which is the best way to go.